Our next guest says that market risks may drive a correction into the end of the year, but he advises investors to buy any dips that might show up. For more on the markets right now, we want to bring in Christian Mueller-Glissmann, head of asset allocation research at Goldman Sachs. Christian, let's talk about this a little bit. You think the downdraft that we saw in stocks in August may have just been a warning shot, and there could be a lot more to come?
Yeah, I mean, I don't think we're necessarily bearish. I think our macro baseline is quite friendly. So we do actually think that, you have a backdrop where growth is good, inflation is anchored, central banks are cutting rates. That's friendly for kind of equities, for a pro-risk asset allocation. The challenge is that you're dealing with bullish positioning. And you've been dealing with that going into the summer, maybe more than now. But I think certainly that has contributed to the setback you had in August. And you're dealing with mixed macro data and obviously geopolitical uncertainty in the Middle East and the US elections. So I think there's potential that you get more corrections, and we would buy the dip.
OK, so you're not scared of any downdrafts that would come from this point on. You think that's actually an opportunity. Where in particular would you be looking if you're looking at sectors?
Well, the interesting thing is that we have this framework, this model that actually gives us a sense of when you should be really worried about the bear market. You don't want to buy a dip if you are worried that a 10% correction becomes a 20% plus drawdown. The model currently tells us the reason why you should not be worried about like a severe bear market is two things. First of all, inflation and inflation momentum. I think this kind of decline in inflation we've had in the last year or so has really opened up the central bank put. It really allows for central banks to cushion growth shocks and to some extent financial condition shocks. So we've seen that in August as a case study. So we would expect that a certain responsiveness from central banks can prevent a correction turning into a bear market. And you're just building up a bit of buffer again because bonds have sold off a bit. Bond yields are moving back up again. So I think that's the first reason. And the second reason is actually price momentum. What we found is if equities in a 6 or 12-month horizon go up as much as they did just in the last 6 to 12 months, it's usually because of a macro backdrop that is very strong. And such a strong macro backdrop doesn't disappear in a matter of a few weeks and months. Like it requires a bit more warning signals. And especially with the labor market data starting to look a bit more healthy again, we're currently not having these warning signals. So that's kind of why we're happy to buy the dips. And I think in terms of sectors and themes, I think we're certainly kind of generally, because of our somewhat late cycle position, we're leaning in two areas. Quality growth that gets punished for whatever reason, but in the long run is attractive and can kind of see valuation expansion. And then you pick selective kind of cyclical value laggards that might have suffered significantly because of macro not being as friendly. So that's our strategy going into year end.
Does it matter what we hear today on PPI? Inflation yesterday was a little hotter than expected. The jobs report, jobless claims, was a little stronger than expected yesterday, too. So what do you think the Fed's going to do?
I think you make a great point there. I think we see a shift in the macro markets regime that is very different to the last 1.5 years, where you had good growth, you were somewhat late cycle, and you were worried about kind of recession risk, etc. But it turned out to be a very healthy economy and recession risk relatively anchored, and you had inflation falling at the same time. And that actually is creating, I called it the inverse Goldilocks scenario. Normally, Goldilocks means growth picks up without inflation. What happened in the last 1.5 years is inflation went down without growth going down. So now this negative inflation momentum is behind us. I think we are starting to see less positive impulses from falling inflation. So now growth needs to be taking over as a driver of markets, of risk appetite. So you're shifting from rates relief to growth being a driver. But that is a bit less high Sharpe ratio for equities as a backdrop, because you always have to worry that with the better growth, inflation accelerates too much. That puts upward pressure on rates. We know that the longer dated bond yields have other drivers that are currently putting upward pressure that can weigh on valuations. So the last 1.5 years, equities were driven a lot by valuation expansion. Now it has to be growth. So I think back and forth will happen. We are in the camp that inflation is anchored and disinflation continues. So we're not worried about this particular print or generally prints into year-end. The key worry we have is as you get those rate cuts, do you get a re-acceleration that brings more inflation with it? And we'll have to see when we get kind of more evidence of that.
Yep.